Jeff Bezos takes a salary of $81,840 a year from Amazon. Elon Musk and Mark Zuckerberg have both taken official salaries of $1. None of these men are poor. The strategy that explains this gap has a name inside the tax world: buy, borrow, die. It is completely legal, it is used constantly at the top of American wealth, and once you understand the 3 steps, you will never look at a billionaire's tax return the same way again. Step 1 is buy. Wealthy individuals hold their fortune almost entirely in appreciating assets, mostly company stock, rather than cash. Under the federal tax code, an asset's rising value is not taxed as income while you hold it. Only a realized event, selling the asset, triggers a taxable capital gain. So the first move is simple: never sell. Let the stock appreciate, on paper, indefinitely, and the tax bill on that appreciation never comes due. Step 2 is borrow. This is the part most people miss. If your wealth is locked in unsold stock, how do you actually spend money, buy real estate, or fund a lifestyle? You borrow against the stock as collateral, through what banks call securities-based lending. Firms like Goldman Sachs and Morgan Stanley routinely offer loans to wealthy clients at interest rates far below both the top income tax bracket and the return most of these stock portfolios generate annually. Loan proceeds are not income. They are debt. Under the tax code, borrowed money is never taxed, no matter how large the loan or how it gets spent. This is not a fringe technique. ProPublica's 2021 investigation into leaked IRS data, called the Secret IRS Files, calculated what it termed a true tax rate for the wealthiest Americans, comparing taxes actually paid against the growth of their total wealth, not just their reported taxable income. Warren Buffett's true tax rate over the period studied came out to roughly 0.1%. Jeff Bezos's came out to about 0.98%. Elon Musk's came out to about 3.27%. Compare that to a typical middle-income worker, whose federal effective tax rate, including payroll taxes, sits in the 13 to 14% range according to Congressional Budget Office data. Step 3 is die, and this is where the loophole seals itself shut permanently. When the asset holder eventually passes away, their heirs inherit the stock at what is called a stepped-up basis. The asset's cost basis, the number used to calculate capital gains tax, resets to the asset's fair market value on the date of death. Every dollar of appreciation that built up over the original owner's entire lifetime is erased for tax purposes. It is never taxed as a capital gain, not by the original owner, and not by the heirs, because on paper, no gain ever technically existed once the reset happens. Loans against the estate get paid off using some of the newly stepped-up assets, and the wealth transfers to the next generation largely intact. The scale of this is not small. The Joint Committee on Taxation and Treasury Department estimates have placed the annual revenue cost of the stepped-up basis provision at tens of billions of dollars, with cumulative estimates over a 10-year budget window running into the hundreds of billions. That is money the federal treasury structurally never collects from the largest, most appreciated fortunes in the country, by design, under existing law. None of the 3 steps, buying and holding, borrowing against collateral, or the basis step-up at death, is tax evasion. Each one is explicitly written into the tax code, has been for decades, and is available to anyone with enough appreciating assets to use it as collateral. The catch is that almost nobody outside the top slice of wealth actually holds enough in appreciating assets to make step 2, the borrowing, functional as a full replacement for a paycheck. For a typical worker, income is wages, and wages get taxed the moment they are earned, with no buy, borrow, or step-up option available at all. So what do you actually take from this? First, understand that the tax code treats income from labor and income from capital very differently, and that difference compounds enormously at scale. Second, recognize that legislative proposals to tax unrealized gains, or to eliminate the stepped-up basis at death, are not abstract policy debates. They are direct attempts to close exactly the loop described here, which is why they generate such intense lobbying resistance every time they reach Congress. Third, if you are building any amount of wealth yourself, understand that the ownership side of this equation, however small, behaves the same way. Unsold appreciation is not taxed. That principle scales down as well as it scales up. If you want more breakdowns of exactly how the tax code actually works, not the talking points, but the mechanisms, subscribe and hit the bell, because I cover this every week. And tell me in the comments, should stepped-up basis be closed, or does it protect something worth keeping? See you in the next one.